Bonsoir à tous. Good evening, everyone. What a pleasure it is to be with all of you here tonight. I'm just going to lower this a bit so I can still see you. I have been in retail for a very long time, a 30-year career, most recently at Indigo Books, where I was for 21 years and left as president, and joined RCL, as we call it, Reitmans Canada Limited, just over a year and a bit ago. And one of my first priorities was to reconnect and to connect with our shareholder community. And it's been a pleasure to do so, and I'm especially excited to be here tonight with all of you to talk about our business. We've also engaged Maison Brisson, and we're here with Pierre Boucher tonight to help us re-embark on those investor relations. I will not read the disclaimer. So RCL, for those of you who may not know us, we are a 100-year-old Montreal-based, Montreal-founded company, started in 1926 on Saint Laurent Boulevard with one store, and now have grown to 400 stores from coast to coast to coast across Canada. We've been publicly traded for 78 years, joining the TSX in 1947. And what has been our long-term success and where have we won? Our customers tell us, and I've met thousands of them now, that no one beats us when it comes to the combination of quality, style, and fit, and being able to rely on us. So as I said, we have almost 400 stores across Canada. We have 3 brands within our portfolio, the first being Reitmans, and we are the only brand that serves that 40-year-old woman, and we'll serve younger and older too, but that's our target customer, across all of Canada for all of her needs in one place. So in our Reitmans stores, and many of you probably have spouses or partners who shop with us, we have everything she needs for work, for casual, and for activewear. And this is our longest term brand, and we're very happy with the results we're seeing there. Next is Pen, and again, we're the only plus size retailer from coast to coast to coast, with stores across the country, and we serve our plus-size female customer in those stores. And then RW & Co is our unisex brand, serving men and women. And this is our younger brand, so when we say zillennial, we mean around 28 to 32, you know, that older Gen Z, younger millennial, who's coming in for great quality, but at accessible prices for workwear, for wearing on dates, to be super fashionable. There's a bit of a new leadership team at RCL. So we've, again, been around for 100 years, and we've had a lot of great seniority over that time. And I was brought in with the mandate to help us grow the business and help us modernize the business. And I'm doing so with a fantastic team. You'll meet Caroline Goulian in just a little bit, and I'll allow her to introduce herself. She brings in both some experience in RCL and great experience in external companies as well. Jackie Tardif has been with us for 30 years, so with a lot of new faces, allows us to have somebody who understands the business inside and out and grew up as a merchant all the way up to COO. And then Isabelle Leclerc just joined us in September as Chief People Officer. Most notably, she was at Québecor for quite a bit of her career. And so in this past fiscal, we had a lot of great accomplishments, including opening 7 new stores, renovating 27 stores, and trying an expanded concept of our RW & Co brand in Sherway Gardens in Toronto. Those of you in Toronto will know that mall. That's doing really great for us. And we've also invested in some modernization in our distribution center, including a robotic system that automates a huge amount of work that we were previously doing by hand. Overall, for financial highlights for last fiscal year, we did about $795 million in revenue, 22.9 in results from operating activities, and a $29.2 million adjusted EBITDA. One of the great things about our brand is we're able to sustain results in even economic challenges. Our customers count on us for that quality, style, and fit, but at accessible prices. So when the economy hits a bump, we are there for our customer to make sure she and he can still fill their wardrobe with something new, something of great quality, without the price point. So Caroline will go through some of the year-to-date results for F25.
Bonsoir tout le monde. Mon nom est Caroline Goulian. Je suis chef des finances chez Reitmans Canada Limitée. Ça fait 4 ans et demi que je suis revenue chez Reitmans et ça fait environ 2 semaines que j'ai été nommée chef des finances. Auparavant, j'ai travaillé chez SNC-Lavalin. J'ai aussi passé plusieurs années, plus de 10 ans, chez Aéroplan, qui est maintenant EMEA. So I'll do the rest of the presentation in English if that's okay, but you can certainly ask your questions in French. So essentially, if we look at Q2 year-to-date results for fiscal 2025, so the year that's going to be ending at the end of January next year, we were really pleased with our revenues. So our revenues increased for the first half of the year by about $1 million. They were relatively flat. But that being said, we did so with 16 less stores. So we finished the second quarter with 389 stores. Essentially, our comparable sales, which in the industry is same-store sales, as well as e-commerce, were also flat. However, the positive in this is that our store sales, or bricks or mortar, increased by about 1.3%. And that's a good thing because we really do want customers to come into the store, to feel the product, to interact with our sales associates, and also to feel the brand. As we saw during COVID as well, we saw a spike in e-commerce, and things are really stabilizing at this point. So for us, this is a good thing. As such, our gross profit, we're also very pleased with gross profit, as you can see. So from 208 to 221 million dollars. That's almost $13 million increase, and that's despite a more challenging FX environment. So essentially, we purchased several hundreds of millions of dollars of goods in US dollars. So essentially, a change or a fluctuation in USD in the foreign exchange rate has an impact on us. As you may see in our reported results, we purchased forward contracts to help reduce the impact of US and Canada exchange movements. Our gross margin rate, which is a really good story, increased from 54.8% last year to 58%, and Q2 alone from almost 56 to 59%. So essentially, we had the right goods at the right time, and so we were able to reduce our promotional activity. Our adjusted EBITDA, which is our EBITDA net of lease depreciation and interest, increased by 35.2% to $24.2 million year to date. And that's after 2 strong quarters. And that was mainly fueled by our gross margin pickup. Consequently, our net earnings were up almost 50% to $14.2 million, and also driven by gross margin. Our effective tax rate remains unchanged since last year. We're also very pleased with our EPS, increasing from 19 cents to 21 cents year to date. We have a solid balance sheet. Our cash at the end of Q2, $124 million, really gives us the flexibility to reinvest in our business, essentially. And that's up about $7.3 million over last year. Our working capital is also up $8.4 million at $168.4. And we have a credit facility which we acquired as we exited from CCAA, which we have not been using. In fact, we used it for a very short period of time once we exited. We've already started to invest in stores, refreshes, renovations, some new locations as well as some equipment in our distribution center, and as well some system upgrades. So we're well positioned with our balance sheet to do further investments. Year to date, so far, we spent about $13 million in improvements, and we plan to invest up to $32 million this year. We announced last June that we'll be acquiring up to 10% of Class A shares outstanding over a period of 12 months, so from last August to the upcoming August in 2025. And what we've done is we've set up an automatic share purchase plan with a broker so that we can acquire the shares even during blackout periods. So far, we've acquired almost 112,000 shares and spent about $276,000. Turn it back to Andrea.
So then the question is, where are we going from here? And where's the growth going to come from? One of the things I found in my first year and a bit at RCL is how well run the company is. And you just saw it in the financials that Caroline presented. But the culture also, there's a depth of experience and talent and a really positive culture that the opportunity as we see it is to invest in growing the 3 brands that we own and have strong market share in. So we have 3 pillars to our strategy. The first is driving that brand growth. The second is we need to invest in some modernization. A 98-year-old company has some older systems and older architecture, and we're going to be investing in those. And then finally, driving the performance of the internal teams. For Reitmans, our goal for driving growth is continuing on a path that's working really well for us, which is meeting that customer that I mentioned earlier where she's at. She doesn't have a lot of options, and she loves shopping with us. We're driving the frequency with some more on-trend styles, some great investments in store refreshes. We even opened 3 new store locations just this week, 1 in BC, 1 in Toronto, and 1 here in Montreal. So really investing in getting that footprint in the right space. In RW & Co, we see pretty significant growth opportunity in this brand, in particular in menswear. So the menswear is performing very well. We've talked about it in our past quarterly results, and we're seeing that continue. And we believe there's a white space in the market for menswear at the price point and quality level we have it. There isn't competition today, and our customer tells us he wished we had more choice and more places for him to shop, and so we're going to give him that. We're also going to invest in women's at the same time to keep that to the right level, but the growth will mostly come from men's. Additionally, we've been working with a firm out of London, UK, to develop a new flagship store design that we can bring across the country to really show that position of a fashionable young brand in RW & Co. And we're opening our first flagship location with them in fall of next year. And then Pen, we again have market share across Canada, and we have a hold on that. But we're trying some new store concepts. Some smaller store locations, some locations in areas where we haven't before to see how we can penetrate and get more market share there. As I mentioned, 98-year-old company, there's some modernization work to do. We talked about our distribution center, we're continuing to do that, but speed to market is really important in fashion. And the trends are even shorter and tighter than ever before, as everyone is live on Instagram or TikTok or wherever, seeing what's hot. So having great speed to market is really important. We've been investing in 3D digital product creation and many other projects to be driving that speed to market from where we manufacture to our stores across the country as quickly as possible. We're also going to be modernizing our digital experience for our customers who are shopping e-commerce. As Caroline mentioned, it's an important part of our business. It's stabilized, but we do believe it could grow again with a modern experience. And finally, we have some process automation, the distribution center, our internal functions to be driving efficiencies, as well as using AI. And then finally, in a company with the kind of talent we have, and talent based here primarily in Montreal, as well as a wholly owned subsidiary in Hong Kong that runs our business and manufacturing in Asia, we're going to be investing in driving high performance, setting strong targets, giving the people the training they need to grow. The other piece is enhancing and investing in investor relations. We think that's an important part of what we do, and we plan to make this the start of many good conversations. And so, we're one of Canada's largest specialty fashion retailers. Our customer base, really important to say, is incredibly loyal. We track customer satisfaction rates and something called Net Promoter Score. So how likely are you to promote this company? Numbers like I've never seen before in my 30 years in retail. Our customer loves us. They want to shop with us more often, and we're going to give them those reasons to continue to do so. We have the best real estate. It's a big asset of ours to have almost 400 stores and counting. This is actually old now. We're at 392 as of this week, and we have all of the best real estate locations in Canada. We're there. And then, as Caroline mentioned, no debt and a very strong cash position to fuel the investment and growth. And so that's our presentation. We're happy to answer any questions. Et en français ou en anglais, comme Caroline a dit aussi. Caroline, do you want to join me? Richard. So just so everyone heard it, we have bought back 111,000. Why haven't we bought back more? I'll let Caroline take that.
It's certainly not from lack of trying, that's for sure. So essentially, look, the stock doesn't move that much. Whenever there is an opportunity to pick it up, we certainly do. So we've set up the automatic process in place, and you know, we're hoping to get to that number by next August, but that's where we are right now.
Great. Thank you, Richard.
Do you own any real estate you have some of your stores?
Do you want to go ahead? Yeah.
We don't own any of our stores. We own 2 buildings. We own the distribution center that we currently operate, and we also own our head office, which is on Sauvé Street.
You talked about the investments in growth and how you're going to integrate same-store sales, and you also talked about unit economics and how you'll drive same-store sales growth.
Yeah, great question. So everyone heard that. How are we going to grow our sales? How are we going to grow same-store sales? I mean, we are now. You saw some of the results that Caroline presented for our previous quarter. We are now. Fashion's a really interesting business. I mean, it's about getting the product right and getting it right always, and continuing to move it quickly to get it right. As I mentioned, we have a strong team of designers. We stay very connected to our sales and what our customers are saying, and we're just always on the pulse of it. The store environments themselves, worth noting, some of them haven't been touched in 20, 30 years. You can't take that for granted. I have visited now dozens and dozens of our stores, and some really need investment. And we see direct payback on the investments we make. So there are no store renovations or openings that we do without direct payback. So we have a great model there to support that.
For this year?
Yeah, you want to go? You talked about that?
Yeah. So as I mentioned, it's $32 million for this year, and so far, as of the end of Q2, we spent 13 of it.
Mathieu.
Talk about the competitive landscape. What are the brands that maybe compete with?
Yeah, great question. So what's our competitive landscape? It's different for each brand, which is, I think, really important to say, because each has their own unique value proposition, and we're moving them in that direction so they aren't competing with each other. So first of all, very important to say that. In an incredibly busy competitive environment, competition is actually good, first of all. If someone's going to be excited to go somewhere to the mall, we're going to get benefit from that too. So in retail in particular, you want good competition. For Reitmans, our customers are shopping. They'll tell us they're shopping at Winners, they're shopping at Old Navy, they're shopping at Walmart, and they enjoy us for a bit more of an elevation to those experiences. Our RW customers are shopping at Aritzia, they're shopping at the Bay, they're shopping at Simon's, so that's the group there. And then Penn's is shopping at Torrid, is starting to shop in more online businesses, but we have a pretty solid market share there.
Just a follow-up, you mentioned the speed from product design to the customer. Can you talk about the current cycle? How long is the cycle right now, and what's the goal in the future?
Yeah, the cycle depends on the product. There are some products that we chase, as we say, in season, where we can drive the product in for the season, and the seasons are relatively short. Very similar to what you were hearing from iFabric earlier, we can range from 6 to 9 months for the core and mass of our product. We believe we can go faster. So to be determined the exact targets, but the faster we can get while maintaining the profit margin is our goal. And technology is really, truly enabling that like never before.
So even if you maximize the buyback, I mean, you're still significantly overly capitalized. So, you know, would you return that to shareholders with special dividend or acquisitions? I mean, I know Brad talked about intimates and stuff a decade ago. Where could you go M&A-wise or use of cash?
So I heard dividend, acquisition. What was the third thing? I missed you. No. Okay. For dividends, it's in discussion with our board of directors. So myself and the rest of the board of directors are discussing shareholder value of different kinds. So to be shared at a later date and to be determined. In terms of acquisition, we're open to potential acquisitions. We're not searching them right now. We believe that we need to keep our focus on investing in the brands we have, We see big growth there, and we want to stay focused. Again, we're open to the discussion. If something right comes along, we'll consider it. Yes.
Can you talk about your inventory turnover and that trend for the last direction it's going?
So in terms of inventory turns, I mean, part of what we offer for our customers is a wide selection of products. It's what they requires from us and they love from us. So our turns, we don't disclose our turns externally at this point. I'll just say we don't have any inventory, negative inventory position. That was one of the things I was most impressed with in terms of joining this company. Never seen a retailer without some aged stock. Our stock is not aged. We move through it really efficiently, really effectively, and don't have it stay past season. So just very healthy overall management of stock, and I would argue one of the best in Canada, if not larger geographic area than that. Thank you. Richard.
Sorry, one more question. What percentage of your purchases are made from a third party?
Oh, that's interesting. So we have our Hong Kong office where we control the purchasing, and then we do also go direct and work through agencies as well. We don't share that number externally. We like that there's kind of that internal competition against one another, and so it allows us to keep ourselves competitive with what's out there in agency, and we're trying some actually new partnerships right now on with some pretty cool new technology on how we can even push that further. Great question. Great. Thank you all very much.